Nobody thought silver could break $65 this fast. Nobody believed the vaults could empty in a single quarter. And nobody expected the same pattern that triggered the silver explosion of 1979 and the solar shortages of 2011 to merge into one unstoppable event. But it's happening now, and the real mystery isn't the price. It is why every major institution is suddenly acting like the price doesn't matter at all. They're not buying silver, they're securing access to silver. And that shift is what turns a simple rally into a global restructuring event. Because when silver breaches $65, it isn't just another commodity breakout. It is the moment 100 hidden contracts activate. 3 nations flip their energy strategies overnight. And a market built on 20 years of cheap solar supply hits a wall so violent that economists are calling it the solar cliff. A point where demand goes vertical, supply goes flat, and the vaults get drained faster than they can be refilled. But here is the part almost nobody understands. The vaults didn't empty because investors bought silver. They emptied because governments did. And the story behind that begins decades before today, with a quiet decision made when silver was worth less than the cost of digging it up. For years, silver looked boring. Gold took all the attention, crypto took the headlines, and silver was written off as a relic of old monetary systems. But in the early 2000s, something subtle changed. Engineers discovered that silver wasn't just desirable, it was irreplaceable. The highest conductivity metal on Earth became the backbone of solar panels, electric vehicles, advanced batteries, medical technology, military optics, and every layer of modern electronics. Silver stopped being just money. It became the bloodstream of the energy transition. And the moment that happened, a countdown began. Because while demand exploded, supply never matched it. Most silver mines shut down between 1990 and 2010 because prices were too low to justify expansion. Miners warned that cheap silver was artificial and dangerous, but nobody listened. Governments built energy policies on the assumption that silver would always be abundant. Corporations scheduled 20-year production plans based on prices that were never real, and Wall Street quietly sold paper promises of silver that didn't exist in the physical world. These decisions created a gap, a tiny gap at first. But year after year, solar manufacturing doubled. Electric vehicles multiplied. Data centers consumed more power. Military programs shifted to sensor-heavy warfare, and the gap turned into a canyon. By 2023, the world was consuming more silver than it could possibly mine. By 2024, shortages started appearing in private refiners, and by early 2025, the cracks became so wide that vault managers quietly told their largest clients, "We will fill your orders, but not immediately." That timeline should sound familiar, because the same pattern appeared in 1979, right before silver hit $50. The same pattern appeared in 2011, just before solar demand pushed inventories to their limits. Patterns never repeat perfectly, but they rhyme. And this time, the rhyme is louder, faster, and driven by forces 10 times bigger. When silver hit $65, investors thought it was speculation. But behind closed doors, this wasn't investor-driven. It was defensive buying from nations preparing for a solar bottleneck so severe that even a minor interruption could freeze entire grids. Countries that promised net zero timelines suddenly faced the reality that without silver, solar expansion stops. Without solar expansion, grid reliability collapses. And without grid reliability, economic stability becomes a guessing game. That's why the vaults emptied. Not because silver was expensive, but because governments realized it was priceless. But let's go deeper, because the real story begins long before $65. It begins in the years no one paid attention to, when silver was hovering between $14 and $18. That period created the perfect storm. Back then, solar companies locked in long-term supply contracts that assumed silver would remain cheap forever. Banks encouraged the strategy because it stabilized financing. Governments encouraged it because it accelerated renewable adoption. But the cost of that stability was illusion. A system built on low prices hid the fact that mining output was quietly declining. Old mines dried up. New mines weren't being built. Recycling couldn't keep up. And no one accounted for the exponential demand curve of solar technology. Silver demand didn't grow in a straight line. It grew in leaps, each leap tied to a technological milestone. First-generation solar cells used small amounts of silver. Second generation used more. Third generation, the ones pushed by global climate initiatives, used nearly twice as much. And now fourth generation hyper-efficient solar cells use over 3 times more silver than the panels used only 10 years ago. This wasn't linear demand, it was compounding demand. And compounding demand eventually hits a wall. That wall is the solar cliff. The solar cliff isn't just the point where silver becomes scarce. It's the moment the energy transition becomes mathematically impossible without a structural reset of silver supply. When silver demand keeps rising, but production cannot rise with it, the result is a cliff where every step forward requires more silver than the world can supply. Industry analysts tried to warn policymakers. They published models showing the gap. They explained that silver production would need to double by 2030 to meet energy goals, but doubling production would require silver prices above $70. No government wanted to admit that. No corporation wanted to price that into their costs. And no financial institution wanted to acknowledge that the majority of paper silver contracts could never be physically settled. So they ignored it until they couldn't. The first failure point didn't appear in mines, it appeared in refiners. Refiners quietly told electronics companies that orders were being delayed. Solar manufacturers started offering premiums to secure shipments. Auto companies revised production schedules. And in 3 major countries, energy ministries held emergency meetings to assess silver security, a phrase that had never appeared in policy documents before. Then came the turning point, when 2 of the largest vaults in Asia reported a 7-day period where more silver left the building than entered. That has only happened twice in modern history. Both times preceded major price events. This time, it triggered a chain reaction that spiraled across continents. Banks noticed the inventories falling. They increased spot purchases. That raised prices. Higher prices attracted industrial buyers worried about future supply. That accelerated withdrawals. Lower inventories made governments nervous. Governments placed massive orders to secure multi-year reserves. That drained the vaults faster. And within weeks, the system snapped into a self-reinforcing shortage loop. That's why prices hit $65. Not because of speculation, but because the system reached a mathematical limit. But here's the part only a few insiders know. $65 is not the ceiling, it's the floor of the next cycle. The real shock isn't what silver costs today. It asks what it will cost when nations realize they need more physical silver than they be budgeted for, and when solar companies realize they can't meet production goals without paying whatever the market demands. This is where the story shifts from economic to geopolitical. 3 countries made moves that changed the entire trajectory of silver demand within a single month. The first increased solar infrastructure targets by 20%. The second nationalized several private mines. The third announced a military modernization program heavily reliant on silver-based technology. These moves weren't coordinated, but they collided in the market like tectonic plates. When those announcements hit the financial world, banks didn't just adjust silver forecasts. They rewrote them entirely. Analysts who predicted $30 silver revised it to $100. Analysts who predicted steady supply admitted that deficits were permanent. And institutions that once mocked precious metals as barbaric quietly began accumulating physical silver as fast as they legally could. But this leads to the real question. Why did the vaults empty now and not earlier? Because a hidden factor accelerated the crisis. A factor most people don't even know exists. It's called silver drift. Silver drift is the phenomenon where silver, originally allocated for industrial use, gradually disappears into long life cycle technologies. When a smartphone reaches the end of its life, the silver can be recycled. But when a solar panel is installed on a rooftop for 30 years, that silver is effectively removed from circulation. Each year adds more long-term installations, meaning more silver disappears into the grid. The world isn't just using silver, it is absorbing silver into infrastructure that won't return it until 2050 or later. That means the market must supply not just current demand, but demand plus annual drift. And once drift exceeds newly mined supply, shortages become permanent. By 2024, drift surpassed production growth. By 2025, it surpassed total physical availability in private vaults. And that is where the solar cliff truly begins. But the collapse of inventories tells an even deeper story, one that connects today to every major silver shock in history, the disconnect between paper silver and physical silver. For decades, the market has operated on the assumption that paper contracts represent real metal. But when withdrawals accelerate and vaults don't refill, the illusion breaks. That break creates panic. Panic creates premiums. Premiums create shortages. And shortages expose the truth, that most silver traded on screens never existed in the first place. The people who understood that dynamic moved early. Mining companies started stockpiling instead of selling. Solar giants locked in multi-year supply agreements. National treasuries quietly bought physical silver without making public statements. And private investors who watched refinery backlogs grow realized that silence was the first red flag. The real explosion came when vault managers sent their most important clients a quiet message. Physical settlement may be delayed. Those 6 words triggered the largest week of silver withdrawals in modern history. It was the spark that ignited the breach. And now the mystery isn't how silver hit $65. It's how far the shortage can go before the system runs out of options. Because here's the truth. We are now past the point of easy fixes. Silver mines take 5 to 10 years to build. Recycling cannot scale fast enough. Solar demand is accelerating faster than any commodity model ever predicted. And governments are competing for the same shrinking pool of supply. That is why the vaults emptied. Not by accident, but because the entire world tried to move into the future using a metal that no one bothered to secure. This crisis was built one decision at a time, and every decision had a consequence. But the story doesn't slow down here, because silver breaching $65 didn't just trigger panic buying, it triggered a global reshuffling of power. Suddenly, the countries with the biggest silver resources weren't just mining economies, they became energy gatekeepers. And the nations that built trillion-dollar renewable plans without securing silver supply were forced into a silent bidding war that pushed prices even higher. A war nobody admits publicly, but every insider can see unfolding in real time. The first sign appeared when 3 major solar manufacturers announced sudden, temporary shutdowns of their production lines. They blamed maintenance, they blamed inspections, they blamed safety reviews, but industry analysts saw the truth instantly. They didn't have the silver paste required to keep the lines running. These companies had supply contracts on paper, but not enough physical material to stay operational. That gap revealed how fragile the entire renewable system really was. From that moment, everything accelerated. Auto manufacturers dependent on silver-heavy electrical systems placed emergency orders at premiums so high that analysts called them panic rates. Military contractors demanded priority shipments, arguing national security. Semiconductor companies negotiated quietly behind closed doors to prevent disruptions to chip fabrication lines. And every one of these moves drained the vaults further. The public didn't know it yet. Investors didn't know it yet. But inside the vaults, the people who actually handle physical silver were watching inventory levels fall like a dam cracking open. And when a dam cracks, it doesn't crack slowly. It goes all at once. The first vault breach happened in Switzerland. Not a literal breach, but a mathematical one. Their reported inventory hit a level so low that analysts who study warehouse flow warned that any additional outflow would break the model entirely. Within 4 days, 3 major funds requested physical settlement. By the end of the week, more silver had left European vaults than in the entire first quarter of the year. But the real shock came when the largest North American vault reported its lowest silver balance in over 2 decades, a balance lower than during the 2011 silver squeeze, lower than during the financial crisis, lower than during the pandemic shutdowns. It was the first time since records were kept that vault managers publicly acknowledged a critical tightness in available supply. That phrase, critical tightness, spread across the industry like wildfire. Governments noticed, banks noticed, industrial buyers noticed, and for the first time, the fear wasn't that silver was becoming expensive. The fear was that silver was becoming unavailable. This is the moment every commodity historian understands as the point of no return. The moment when supply no longer reacts to price, the moment when the market breaks free from fundamentals and becomes a scramble for survival. Once that happens, price charts stop behaving like markets and start behaving like signals of distress. But the strangest twist is that this crisis didn't begin with investors. It began with engineers. Engineers quietly warned that next-generation solar panels would require even more silver than expected. They warned that efficiency targets of 28% and above were impossible without increased silver loadings. They warned that global climate agreements assumed silver consumption levels that were unrealistic. And they warned that silver deficits would become permanent unless new mining projects started immediately. But those warnings were ignored because they didn't fit the narrative. Governments wanted cheap energy. Companies wanted cheap components. Banks wanted orderly markets. And the result was a global system built on unrealistic expectations. A system that only needed one shock to fall apart. The shock came when a large Asian solar manufacturer accidentally revealed internal documents showing a silver exposure risk index. The report outlined the consequences of silver shortages, including delayed production, grid instability, and long-term renewable setbacks. That document leaked. Analysts connected the dots. And suddenly, the phrase solar cliff became mainstream inside energy circles. The solar cliff isn't a metaphor, it's a chart showing silver demand rising vertically while supply stays horizontal. When those 2 lines diverge too far, the system collapses. And once the collapse starts, demand destruction becomes the only stabilization mechanism. In simple terms, prices rise until enough companies give up. But here's the chilling part. The world cannot afford to give up on solar. Every major economy is now dependent on renewable expansion. If solar slows down, grid reliability weakens. If grid reliability weakens, inflation rises. If inflation rises, governments lose stability. Silver isn't just a commodity anymore. It is the foundation of modern civilization's energy blueprint. That SY, silver breaching $65, wasn't a price movement. It was a structural alarm. But the force behind the alarm goes deeper than energy. It goes into the financial architecture built on paper silver. For years, banks have sold paper claims representing silver they never intended to deliver. These contracts were used to hedge, to speculate, to trade, all without touching physical metal. The ratio of paper silver to physical silver became so inflated that if even a small percentage of holders requested delivery, the system would crack. And then someone did request delivery, several someones. Enough someones that vault managers began delaying response times. Enough someones that premiums rose across every major bullion dealer. Enough someones that physical silver shortages appeared simultaneously on 3 continents. When bankers faced questions behind closed doors, their silence spoke louder than numbers. They knew the truth. The system wasn't designed for physical settlement. It was designed to prevent it. But this time, the world didn't want promises. The world wanted metal. And that shift pushed prices through $65 like a knife through paper. Because once physical demand overwhelms paper control, the market becomes a physical market again. And in a physical market, scarcity rules everything. But scarcity alone doesn't explain the vault collapse. There was another catalyst, a geopolitical one, that changed the trajectory of silver in a single day. A major nation, facing energy instability, quietly passed legislation allowing their treasury to acquire strategic quantities of silver for renewable infrastructure protection. That phrase may sound harmless, but the details were explosive. The Treasury received emergency authority to bypass normal procurement rules and acquire physical silver directly from foreign suppliers. They also gained the power to restrict domestic exports of refined silver. In one move, a major nation became a competitor to every industrial buyer on Earth. The moment this decision leaked, traders didn't ask how much silver they would buy. They asked how much silver they would remove from global circulation. Because governments don't sell silver once they acquire it. They store it. They lock it away. They treat it the same way they treat oil reserves, grain reserves, or gold. A government buyer entering the silver market is a permanent buyer. That was the moment silver breached $65. But the shocking part was that the price movement wasn't violent. It was controlled, steady, deliberate. Exactly what happens when large players accumulate without drawing attention. Smart money wasn't chasing the market. It was absorbing the market. But then came the final trigger, the solar grid shock. A major research institute released a paper showing that by 2032, the world would need more silver for solar production alone than the entire mining industry could supply. Not total demand, just solar. When that paper reached energy ministries, the reaction was immediate. Countries began calculating their own exposure. Companies reassessed their procurement strategies. And investment funds realized that silver was no longer a speculative metal. It was a structural necessity. The effect was instant. Vault inventories collapsed, not because people wanted silver, but because people needed silver. Industrial users began converting cash reserves into physical metal. Solar companies rewrote contracts overnight. Mining firms renegotiated supply deals at higher prices. And nations that once ignored silver began quietly accumulating it as a strategic asset, alongside lithium and rare earths. That when the final pattern appeared. The same pattern seen before every major commodity shock in history. Substitution panic. When a resource becomes scarce, companies search for alternatives. They run experiments. They test new materials. But with silver, substitution is nearly impossible. Copper can replace silver in some applications, but at lower efficiency and higher energy loss. Aluminum can replace silver in wiring, but not in photovoltaic cells. Graphene is promising, but not ready for industrial scale. Silver is not optional. Silver is foundational. And that truth spread through the industry like a revelation. Suddenly, analysts who once mocked silver bulls began issuing warnings. Suddenly, economists who dismissed silver as importance began calling it the critical Achilles heel of the energy transition. And suddenly, governments realized the future they promised their citizens depended on a metal they never bothered to secure. This is the core of the crisis. The world assumed silver was infinite. Now it knows silver is finite. And the moment that realization spread, the vaults began to empty. But the real danger is not what happened. It's what happens next. Because once vault inventories fall below operational thresholds, markets enter a stage known as structural deficit shock, a stage where shortages become permanent unless production increases dramatically. And right now, production cannot increase dramatically. The math simply doesn't allow it. This is where the narrative reaches its turning point, the moment when the market transitions from tightness to risk, not price risk, not volatility risk, but systemic risk. Because if silver supply cannot meet solar demand, and solar demand cannot slow down without destabilizing national grids, then silver becomes the single most important strategic material in the energy world. A material so critical that the first nation to control its supply will control the pace of global electrification, and that is why the vaults are empty, why silver breached $65, why the solar cliff became unavoidable, and why the next phase of this story is even more disruptive than the last. Because the next phase is not about silver supply. It is about silver control. For the first time in modern history, energy policy, military technology, and financial stability are intersecting through a single metal. A metal nobody respected when it was cheap, and everybody is now desperate for when it became essential. The solar cliff didn't create this crisis. It only revealed the truth the world tried to ignore. Silver was never a small market. It was a hidden foundation. And foundations matter most when they start to crack. The cracks became visible when private refiners submitted reports showing multi-month delays on industrial orders. They weren't hiding it anymore. They weren't pretending everything was fine. They told manufacturers openly, "We cannot meet full output without higher grade feedstock." Higher grade feedstock means physical silver. Not paper, not contracts, not forward agreements, actual metal. And when global refining capacity starts signaling distress, it is only a matter of time before the shortages spread into consumer markets. Dealers began rationing orders, not because they wanted to, because they had to. Large buyers were taking entire allocations the moment shipments arrived. Some buyers paid 40% premiums above spot just to secure priority. Others locked in prepayment contracts with miners to guarantee supply before it ever hit the market. And quietly, behind the scenes, one of the largest EV manufacturers in the world offered to buy an entire year of silver output from a major Latin American mine. That offer changed everything, because it proved that silver was no longer trading as a commodity. It was trading as infrastructure. Whoever held it controlled the future. Whoever lacked it faced delays, lost competitiveness, and potential shutdowns. The market understood that instantly. And once corporations began hoarding silver not for speculation, but for production insurance, the price mechanism broke entirely. Economists call this behavior preemptive accumulation. Historically, it only occurs before major supply shocks. It happened before the oil crisis of 1973. It happened before the rare earth crisis of 2010. And now it is happening again, but with a metal that the world consumes at rates far exceeding its ability to replace. This is where the story becomes more than economics, becomes a warning from history. In 1979, when the Hunt brothers tried to corner the silver market, the world panicked because it saw the price go vertical. But the real reason for the panic wasn't speculation. It was the realization that physical silver supplies were far tighter than anyone believed. The banks were exposed, the exchanges were exposed, and the illusion of abundant silver shattered. The same illusion exists today, but at a scale 10 times larger, driven not by speculators, but by industrial necessity. And unlike 1979, there is no regulatory switch that can magically increase supply. There is no policy tool that can replace silver in energy systems. There is no emergency reserve big enough to stabilize the market. The world built its future around technology that depends on a metal it cannot produce fast enough. And now the cracks are turning into fractures. Semiconductor manufacturers are reporting procurement stress. Battery developers are racing to redesign systems to reduce silver loadings. Electric grid operators are calculating new worst-case scenarios. And the insurance sector, the quiet giant behind everything, has started revising risk models for renewable energy stability. When insurance models change, markets follow, because insurance is the ultimate signal of systemic vulnerability. And right now, insurers are treating silver scarcity the same way they treat political instability, as a material threat to national infrastructure. That's when governments stepped in more aggressively. Some countries increased funding for mining exploration, others imposed new export restrictions. A few even began forming bilateral agreements to secure multi-year silver flows. But every attempt revealed the same problem. New supply takes too long to develop, and current supply is already oversold. A major Latin American nation tried offering fast-track permits to attract foreign investment into its mining sector. Companies responded. Feasibility studies were launched. Sites were surveyed. But analysts confirmed what everyone secretly knew. Even if every proposed mine were approved tomorrow, the earliest meaningful production wouldn't come until 2030. The deficit would continue, the solar cliff would continue, and the vaults would continue to drain. This is why the crisis deepened so quickly. The world believed silver production could scale, but geology has limits, capital has limits, time has limits. Technology has a threshold beyond which substitution becomes impossible. As the crisis unfolded, one more hidden factor accelerated the vault collapse: sovereign accumulation. When governments buy silver, they do it quietly. They don't announce it. They don't publish reports. They simply acquire metal and hide it in national reserves. And because sovereign purchases do not show up on public exchange data, the true scale of global demand becomes invisible. But you can measure it by observing anomalies. Vaults that historically lost 1% inventory per month suddenly began losing 6%. Refiners that usually maintained 4 weeks of inventory dropped to 3 days. Shipping manifests showed silver bars being exported to destinations that never previously ordered them. And customs data revealed multiple shipments labeled as industrial metals that matched the exact weight of silver consignments. Experts knew instantly. Sovereigns were entering the market. And when sovereigns enter a market this tight, private buyers get pushed out almost immediately. That's why premiums soared. That's why lead times doubled. That's why industrial buyers began panic loading orders months in advance. Because everyone realized the same terrible truth. The vaults were not emptying by accident. They were emptying because the world was quietly positioning itself for a resource war. A war not fought with tanks or missiles, but with contracts, storage, and acquisition of strategic metals. This is why energy ministries started using a new phrase in internal documents: silver security. National strategies now treat silver the same way they treat oil reserves and food reserves. It is becoming a strategic asset that determines whether a nation can meet its climate goals, expand its grid, maintain its defense capabilities, and preserve its technological competitiveness. But beneath all these layers, the price spikes, the shortages, the geopolitical maneuvers, lies the core truth that explains the entire crisis. The world designed a future that consumes more silver than it produces, more silver than it recycles, and more silver than it can substitute. Once that design reached its breaking point, the vaults didn't just empty. They were pulled apart by a force greater than speculation, greater than investment flows, and greater than monetary policy. The force was inevitability. The solar cliff was inevitable the moment solar technology adopted silver-heavy architectures. It was inevitable when EV expansion curves accelerated. It was inevitable when electronic manufacturing became globalized. It was inevitable when energy grids modernized. And it became unstoppable when physical silver inventories fell below critical operational thresholds. This is where the story reaches full circle. Silver breaching $65 is not the end of the crisis. It is the beginning of a new chapter where silver becomes the defining constraint of global progress. And now we reach the point this script has been building toward, the part that explains what this moment truly means for the future. Because behind all the price movements, all the vault withdrawals, all the geopolitical maneuvers, there are three truths every viewer must understand. First, silver shortages are structural, not temporary. The deficit is not caused by investors. It is caused by technology, and technology demand is non-negotiable. That means the shortage will continue even if prices fall, because demand is built into the architecture of the modern world. Second, silver is transitioning from a commodity to a strategic resource. Nations are no longer treating it as an industrial input. They're treating it as infrastructure, as energy, as national security. That shift will reshape supply chains, pricing models, and geopolitical alliances for decades to come. Third, the price you see today is not the real crisis. The real crisis is availability. When vaults empty, price becomes irrelevant. You can have money, but not metal. And in a world dependent on silver for energy, medicine, communications, defense, and transportation, availability becomes more important than cost. Which leads us to the warning. The one message the data makes impossible to ignore. We are now entering a decade where silver scarcity will reshape the energy transition. Nations that secure silver will thrive. Nations that fail to secure it will face rolling instability. And industries that rely on silver but don't lock in long-term supply will collapse under competitive pressure. This isn't speculation. It is the mathematical outcome of a world that consumes more silver than it can produce. So what should viewers do? Stay informed. Follow the data, not the noise. Understand how silver connects to the technology you use every day. Pay attention to energy policy shifts. Watch refinery lead times. Track national procurement behavior. Because the solar cliff will not reverse. It will only accelerate. And before we end, here is a final thought. The same one governments are asking behind closed doors. If silver shortages are this severe at $65, what happens when the world hits 80? What happens at 100? What happens when entire industries compete for a metal the Earth cannot replace fast enough? The world is about to find out. If you learned something valuable from this video, if this opened your eyes to how the silver market truly works, make sure you subscribe, like the video, and share it, because understanding this moment is the key to understanding the decade ahead.